Right now, time for a check on all the business news. Lloyds certainly dominating things this morning. And Susanna Street is here. Hello, Susanna.
Hi there, thanks very much. Yes, we're going to start by talking about Lloyds because the cost of compensating customers who are missold payment protection insurance has pushed Lloyds to a £3.3 billion loss for the 6 months to June. Britain's biggest mortgage lender announced in May that it was putting aside £3.2 billion to pay customers who've been missold. The bank, which is 41% owned by the taxpayer, recently announced a cost-cutting programme, including 15,000 job losses. Well, joining me now is Roebuck, who is visiting professor at Cass Business School. Hello there. So, was it, though, this one-off big hit for the mis-selling of payment protection insurance, which has really pushed Lloyds down, or are there really other underlying issues here for Lloyds that the market wants it to address?
You have to be honest in terms of where Lloyds has come from. You know, we forget that a few years ago Lloyds was actually certainly 2 banks, if not 3 banks. And when you put 3 organisations together, inevitably you're going to end up with too many branches, too many central functions like HR and IT, and potentially too many people. And that restructuring process takes a long time for any organisation, and particularly when you're in a position where it's a really bad economic climate, where you've actually been involved in some mis-selling, then there's a major challenge that the bank has to address, not just in terms of looking at the past figures that we've just seen today, but also what are they going to do in the future.
Now, Lloyds Banking Group share price down 3.8% so far this morning. It certainly seems that many in the city and lots of investors aren't really happy about the news that's coming out, this huge hit, even though Lloyds did pre-warn them, saying that it was going to take this really big hit on payment protection insurance. Is it bigger than the other banks?
Well, I think to a degree, yes, that is bigger than the other banks, but you also have to accept that in this particular week, with all the issues around the US debt crisis, sovereign debt in Europe, everybody is a little bit nervous in the markets. I think as far as not only the markets, but also the shareholders in Lloyds are concerned, the key is the future. The key is whether Lloyds as an institution, with its new leadership, can actually make sure that it's doing the right business, it's doing it efficiently, and it's doing it in a way that actually engages their people, because we talk about the financial side of it, but the financial side of these banks is delivered by the people who work for those banks, delivering great customer service to you and I, so they make great profits and we get our money back. It's that simple.
Could they take a leaf out of the example that building societies are currently setting? They've had a very good report, haven't they, recently, from the ratings agencies?
Yes, I think it's about being as conservative as you need to be safe, but also taking opportunities where you see them. And certainly I think the challenge does go back to the position that Lloyds has come from, which is one which is tough for the people inside, to a point where the new leadership can say, actually, we've got an answer for you, our employees, and we can take you to somewhere that actually is going to be a good place to go, because we know with mergers and acquisitions, if the leadership can do that, it can improve employee performance by 20 to 30%. Now, that does have a bottom line effect, and it means that we get the service we need and potentially we get our taxpayers' money back faster.
OK, well, let's hope that improvements will be on the way. OK, thanks very much, Roebuck.